Good morning, good afternoon, and good evening. Today we will talk about Chapter 10, Part 1. Stay strong. Reaping reward by increasing risk. Behavioral finance. Behavioral finance is not a branch of standard finance. It is its replacement with a better model of humanity. Mayer Statman. Thus far I have described stock market theories and techniques based on the premise that investors are completely rational. They make decisions with the objective of maximizing their wealth and are constrained only by their tolerance for bearing risk. Not so, declares a new school of financial economists who came to prominence in the early part of the 21st century. Behavioralists believe that many, perhaps even most, stock market investors are far from fully rational. After all, think of the behavior of your friends and acquaintances, your fellow workers and your supervisors, your parents, and, dare I say, spouse. Children, of course, are another matter. Do any of these people act rationally? If your answer is no, or even sometimes no, you will enjoy this journey down the less than rational byways of behavioral finance. Efficient market theory, modern portfolio theory, and various asset pricing relationships between risk and return all are built on the premise that stock market investors are rational. As a whole, they make reasonable estimates of the present value of stocks, and their buying and selling ensures that the prices of stocks fairly represent their future prospects. By now, it should be obvious that the phrase, as a whole, represents the economist's escape hatch. That means they can admit that some individual market participants may be less than rational. But they quickly wriggle out by declaring that the trades of irrational investors will be random and therefore cancel each other out without affecting prices. And even if investors are irrational in a similar way, efficient market theory believers assert that smart, rational traders will correct any mispricings that might arise from the presence of irrational traders. Irrational traders. Psychologists will have none of this economic claptrap. Two in particular, Daniel Kahneman and Amos Tversky, blasted economists' views about how investors behave, and in the process are credited with fathering a whole new economic discipline, called behavioral finance. The two argued quite simply that people are not as rational as economic models assume. Although this argument is obvious to the general public and non-economists, it took over 20 years for it to become widely accepted in academia. Tversky died in 1996, just as it was gaining increased credibility. 6 years later, Kahneman won the Nobel Memorial Prize in Economic Sciences for the work. The award was particularly notable in that it was not given to an economist. Upon hearing the news, Kahneman commented, "The prize is quite explicitly for joint work, but unfortunately there is no posthumous prize." Though the insights expounded by Kahneman and Tversky affected all social sciences dealing with the process of decision-making, they had a particularly strong impact on economics departments and business schools across the country. Imagine a whole new field in which to publish papers, give lectures for hefty fees, and write graduate theses. While that may be all well and good for the professors and the students, what about all the other people who want to invest in stocks? How can behavioral finance help them? More to the point, what's in it for you? Actually, quite a bit. Behavioralists believe that market prices are highly imprecise. Moreover, people deviate in systematic ways from rationality, and the irrational trades of investors tend to be correlated. Behavioral finance then takes that statement further by asserting that it is possible to quantify or classify such irrational behavior. Basically, there are 4 factors that create irrational market behavior: overconfidence, biased judgments, herd mentality, and loss aversion. Well, yes, believers in efficient markets say. And we believers always have a but. The distortions caused by such factors are countered by the work of arbitrageurs. This last is the fancy word used to describe people who profit from any deviation of market prices from their rational value. In a strict sense, the word arbitrage means profiting from prices of the same good that differ in two markets. Suppose in New York you can buy or sell British pounds for $1.50, while in London you can trade dollars for pounds at a $2 exchange rate. The arbitrager would then take $1.50 in New York and buy a pound and simultaneously sell it in London for $2, making a 50 cents profit. Similarly, if a common stock sold at different prices in New York and London, it would be justifiable to buy it in the cheap market and sell it in the expensive one. The term arbitrage is generally extended to situations where two very similar stocks sell at different valuations or where one stock is expected to be exchanged. Stocks sell at different valuations or where one stock is expected to be exchanged for another stock at a higher price if a planned merger between the two companies is approved. In the loosest sense of the term, arbitrage is used to describe the buying of stocks that appear undervalued and the selling of those that have gotten too high. In so doing, hard-working arbitrageurs can smooth out irrational fluctuations in stock prices and create an efficiently priced market. On the other hand, behavioralists believe there are substantial barriers to efficient arbitrage. We cannot count on arbitrage to bring prices in line with rational valuation. Market prices can be expected to deviate substantially from those that could be expected in an efficient market. The remainder of this chapter explores the key arguments of behavioral finance in explaining why markets are not efficient, and why there is no such thing as a random walk down Wall Street. I'll also explain how an understanding of this work can help protect individual investors from some systematic errors that investors are prone to. The irrational behavior of individual investors, as Part 1 made abundantly clear, there are always times when investors are irrational. Behavioral finance, however, says that this behavior is continual rather than episodic. Overconfidence researchers in cognitive psychology have documented that people deviate in systematic ways from rationality in making judgments amid uncertainty. One of the most pervasive of these biases is the tendency to be overconfident about beliefs and abilities and overoptimistic about assessments of the future. One class of experiments illustrating this syndrome consists of asking a large group of participants about their competence as automobile drivers in relation to the average driver in the group or to everyone who drives a car. Driving an automobile is clearly a risky activity where skill plays an important role. Answers to this question easily reveal whether people have a realistic conception of their own skill in relationship to others. In the case of college students, 80 to 90% of respondents invariably say that they are more skillful, safer drivers than others in the class. As in Lake Wobegon, almost all the students consider themselves above average. In another experiment involving students, respondents were asked about likely future outcomes for themselves and their roommates. They typically had very rosy views about their own futures, which they imagined to include successful careers, happy marriages, and good health. When asked to speculate about their roommates' futures, however, their responses were far more realistic. The roommates were believed to be far more likely to become alcoholics, suffer illnesses, get divorced, and experience a variety of other unfavorable outcomes. These kinds of experiments have been repeated many times and in several different contexts. For example, in the business management bestseller In Search of Excellence, Peters and Waterman report that a random sample of male adults were asked to rank themselves in terms of their ability to get along with others. 100% of the respondents ranked themselves in the top half of the population. 25% believed that they were in the top 1% of the population. Even in judging athletic ability, an area where self-deception would seem more difficult, at least 60% of the male respondents ranked themselves in the top quartile. Even the klutziest deluded themselves about their athletic ability. Only 6% of male respondents believed that their athleticism was below average. Daniel Kahneman has argued that this tendency to overconfidence is particularly strong among investors. More than most other groups, investors tend to exaggerate their own skill and deny the role of chance. They overestimate their own knowledge, underestimate the risks involved, and exaggerate their ability to control events. Kahneman's tests show how well investors' probability judgments are calibrated by asking experimental subjects for confidence intervals. He asks a question such as the following: what is your best estimate of the value of the Dow Jones 1 month from today? Next, pick a high value, such that you are 99% sure, but not absolutely sure, that the Dow Jones a month from today will be lower than that value. Now pick a low value, such that you are 99% sure, but no more, that the Dow Jones a month from today will be higher than that value. If the instructions are carried out properly, the probability that the Dow will be higher, lower, than your high, low, estimate should be only 1%. In other words, the investor should be 98% confident that the Dow will be within the given range. Similar experiments have been carried out on estimates for interest rates, the rate of inflation, individual stock prices, and the like. In fact, few investors are able to set accurate confidence intervals. Correct intervals would lead to actual outcomes being outside the predicted range only 2% of the time. Actual surprises do occur close to 20% of the time. This is what psychologists mean by overconfidence. If an investor tells you he is, this is what psychologists mean by overconfidence. If an investor tells you he is 99% sure, he would be better off assuming that he was only 80% sure. Such precision implies that people tend to put larger stakes on their predictions than are justified. And men typically display far more overconfidence than women, especially about their prowess in money matters. What should we conclude from these studies? It is clear that people set far too precise confidence intervals for their predictions. They exaggerate their skills and tend to have a far too optimistic view of the future. These biases manifest themselves in various ways in the stock market. First and foremost, many individual investors are mistakenly convinced that they can beat the market. As a result, they speculate more than they should and trade too much. Two behavioral economists, Terence O'Dean and Brad Barber, examined the individual accounts at a large discount broker over a substantial period of time. They found that the more individual investors traded, the worse they did. And male investors traded much more than women, with correspondingly poorer results. This illusion of financial skill may well stem from another psychological finding, called hindsight bias. Such errors are sustained by having a selective memory of success. You remember your successful investments. And in hindsight, it is easy to convince yourself that you knew Google was going to quintuple right after its initial public offering. People are prone to attribute any good outcome to their own abilities. They tend to rationalize bad outcomes as resulting from unusual external events. History does not move us as much as a couple of anecdotes of success. Hindsight promotes overconfidence and fosters the illusion that the world is far more predictable than it really is. The people who sell worthless financial advice may even believe that it is good advice. Steve Forbes, the longtime publisher of Forbes magazine, liked to quote the advice he received at his grandfather's knee. "It's far more profitable to sell advice than to take it." Many behavioralists believe that overconfidence in the ability to predict the future. Biased judgments. I meet investors every day who are convinced that they can control their investment results. This is especially true of chartists who are confident that they can define the future by looking at past prices. Larry Swedroe, in his Rational Investing in Irrational Times, provides a wonderful illustration of how hot streaks occur with much greater frequency than people believe. Each year, a statistics professor begins her class by asking each student to write down the sequential outcome of a series of 100 imaginary coin tosses. One student, however, is chosen to flip a real coin and chart the outcome. The professor then leaves the room and returns in 15 minutes with the outcomes waiting for her on her desk. She tells the class that she will identify the one real coin toss out of the 30 submitted with just one guess. With great persistence, she amazes the class by getting it correct. How does she perform this seemingly magical act? She knows that the report with the longest consecutive streak of H, heads, or tails, is highly likely to be the result of the real flip. The reason is that, when presented with a question like which of the following sequences is more likely to occur, HHHHHHTT or HTHTHTHTHT, despite the fact that statistics show that both sequences are equally likely to occur, the majority of people select the latter, more random, outcome. They thus tend to write imaginary sequences that look much more like HHTHTHTHTT than HHHTHTHTHTH. Aside from the long-term positive direction of the stock market, streaks of excessively high stock returns do not persist. They are typically followed by lower future returns. There is reversion to the mean. Similarly, the laws of financial gravity also operate in reverse. At least for the stock market as a whole, what goes down eventually comes back up. Yet each era's conventional wisdom typically assumes that unusually good markets will get better and unusually bad markets will get worse. Psychologists have long identified a tendency for individuals to be fooled by the illusion that they have some control over situations where, in fact, none exists. In one study, subjects were seated in front of a computer screen divided by a horizontal line, with a ball fluctuating randomly between two halves. The people were given a device to press to move the ball upward, but they were warned that random shocks would also influence the ball so that they did not have complete control. Subjects were then asked to play a game with the object of keeping the ball in the upper half of the screen as long as possible. In one set of experiments, the device was not even attached, so the players had absolutely no control over the movements of the ball. Nevertheless, when subjects were questioned after a period of playing the game, they were convinced that they had a good deal of control over the movement of the ball. The only subjects not under such an illusion turned out to be those who had been clinically diagnosed with severe depression. In another experiment, an office lottery was conducted with two identical sets of baseball cards. One set was placed in a bin from which one card was to be selected by chance. The other set was distributed to the participants. Half the participants were given a choice of which card to take, while the other half were simply given a card. Participants were told that the winner would be the person holding the card that matched the one that would be selected by chance from the bin. The individuals were then told that while all the cards had been distributed, a new player wanted to buy a card. Participants were faced with the choice: sell their cards at some negotiated price or hold on to them and hope to win. Obviously, each card had the same probability of winning. Nevertheless, the prices at which players were willing to sell their cards were systematically higher for those who chose their cards than for the group who had simply been given a card. Insights such as this led to the decision to let state lottery buyers pick their own numbers, even though luck alone determines lottery winners. It is this illusion of control that can lead investors to see trends that do not exist or to believe that they can spot a stock price pattern that will predict future prices. In fact, despite considerable efforts to tease some form of predictability out of stock price data, the development of stock prices from period to period is very close to a random walk, where price changes in the future are essentially unrelated to changes in the past. Biases and judgments are compounded, get ready for some additional jargon, by the tendency of people mistakenly to use similarity, or representativeness, as a proxy for sound probabilistic thinking. A famous Kahneman and Tversky experiment best illustrates this heuristic. Subjects are shown the following description of Linda. Linda is 31 years old, single, outspoken and very bright. She majored in philosophy. As a student, she was deeply concerned with issues of discrimination and social justice, and also participated in anti-nuclear demonstrations. Subjects were then asked to rate the relative likelihood that 8 different statements about Linda were true. 2 of the statements on the list were, "Linda is a bank teller," and "Linda is a bank teller and is active in the feminist movement." Over 85% of subjects judged it more likely that Linda was both a bank teller and a feminist than that she was a bank teller. But this answer is a violation of a fundamental axiom of probability theory. The conjunction rule: the probability that somebody belongs to both category A and category B is less than or equal to the probability that she belongs to category A alone. Obviously, few respondents had learned much probability theory. The description of Linda made her seem like a feminist, so being a bank teller and a feminist seems a more natural description, and thus more representative of Linda, than simply being a bank teller. This experiment has been replicated many times with naive and sophisticated. A 2005 study by Gregory Burns, a neuroscientist, used MRI scanners to examine the workings of the brain to determine whether people gave into the group knowing that their answers were incorrect or whether their perceptions had actually changed. If caving into the group was the result of social pressure, the study reasoned, one should see changes in the area of the forebrain involved in monitoring conflicts. But if the conformity stemmed from actual changes in perception, one would expect changes in the posterior brain areas dedicated to vision and spatial perception. In fact, the study found that when people went along with the group in giving wrong answers, activity increased in the area of the brain devoted to spatial awareness. In other words, it appeared that what other people said actually changed what subjects believed they saw. It seems that other people's errors actually affect how someone perceives the external world. In another study, social psychologists put a single person on a street corner and asked him to look up at an empty sky for 60 seconds. The psychologists then observed that a tiny fraction of the pedestrians on the street stopped to see what the person was looking at, but most simply walked past. Then the psychologists put 5 people on the corner looking at the sky. This time 4 times as many people stopped by to gaze at an empty sky. When the psychologists put 15 people on the corner looking at the sky, almost half of the passers-by stopped. Increasing the number of people looking skyward increased the number of gazing pedestrians even more.